Hey everyone, welcome back to Corporate Dakota. Today, AUID just filed a current report detailing a private placement of debt and warrants, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows the company raising cash through a form of debt that comes with some pretty explosive potential for shareholders down the line. Alright, let's dive into this report from AUID Incorporated filed on the 29th of April 2026. They have announced the closing of what they are calling a private placement, which essentially means they sold securities directly to certain investors without going through the public stock markets. The company name is authID Incorporated, trading under the ticker symbol AUID. They are described as a technology and software company focused on infrastructure, with a recent market cap around $19 million. It is important to note that while they are publicly traded, this specific event, the private placement, involves select investors. Not you or me buying shares on the open market. So what happened here? The company entered into a securities purchase agreement and closed a private placement. They issued and sold about $3.7 million worth of senior secured debentures, which is basically a fancy term for secured debt, along with stock purchase warrants. Now, let's look at the specifics of these debentures. They are senior secured obligations, meaning if the company goes under, these debt holders get paid back before most other creditors. They mature in 6 months. So around October 2026, which is a very short time frame. Interestingly, these debentures do not bear interest. Instead, they are secured by a first priority security interest in substantially all of the company's assets. This means the company is putting almost everything it owns on the line to back this debt. Along with the debt, they issued warrants. These warrants give the investors the right to buy shares of authID's common stock. For every dollar invested in the debentures, they get warrants to purchase a share of common stock at an exercise price of $1.5. These warrants have a 5-year term, meaning investors can hold on to them for a long time. And they can be exercised starting 6 months after issuance. A key feature here is the cashless exercise option, which means investors can potentially get shares without upfront cash. And also anti-dilution adjustments, which protect their investment if the company issues more stock at a lower price. And there are beneficial ownership limitations. Capped at 4.99% or 9.99% of the company's stock, or even 19.99% for a director. This is to manage how much stock any single investor can control. On top of the debentures and warrants, investors also received fee shares. These are essentially extra shares given to the investors equal to 15% of the principal amount invested divided by $1. This is another way the company is giving away ownership. The company also entered into a registration rights agreement. This means they've promised to register the shares issuable from these warrants and fee shares so they can be legally resolved on the public market. They have to do this within 10 days of a certain milestone if they don't secure subsequent financing. They also granted standard piggyback registration rights, which means if the company registers other shares later, these investors can join in. Here is where it gets a bit more complex. The debentures have a most favored nation provision. This means if authID Inc. raises money in another financing deal with better terms for those new investors, the existing debenture holders can effectively convert their debt into those better terms. This could lead to significant future dilution and complexity for existing shareholders on the public market. There is also a NASDAQ 19.99% limitation clause. This is a rule that generally requires stockholder approval if a company issues more than 19.99% of its outstanding stock. This filing implies that the shares issued from these debentures, warrants, and fee shares might exceed that limit, potentially requiring a shareholder vote or risking non-compliance with NASDAQ rules. This section basically confirms that the debentures represent a direct financial obligation for authID Incorporated. It is a formal commitment to pay back this debt. This item clarifies that the warrants and fee shares are considered unregistered sales of equity securities. This means they were not registered with the CC for public sale, relying on exemptions like Section 4, A.2 of the Securities Act and Rule 506B of Regulation D. Assuming the investors are indeed accredited investors. Finally, the exhibits listed here are the actual documents that spell out all these agreements, like the form of the securities purchase agreement, the debenture, the warrant, and the security agreement. These are the gritty details that would give you the full picture if you wanted to dig deep. Now, looking at this from a shareholder's perspective, this is a mixed bag, but leaning towards concerning authID Inc. needs cash. That is clear. They've raised about $3.7 million, which isn't a huge amount for a public company, especially considering their market cap is around $19 million. The fact they are using secured debt with no interest but giving away warrants and fee shares suggests they are in a tight spot. The immediate concern is the short maturity of the debentures and the fact that they are secured by essentially all of the company's assets. If authID Inc. cannot repay this 6-month debt, the creditors could seize the company's assets, which is a very severe outcome. This is a common tactic for companies in financial distress. The warrants are also a significant dilution factor. If these warrants are exercised, a large number of new shares could flood the market, driving down the price for existing shareholders. We've seen this pattern repeatedly with companies in similar situations. For instance, remember when Kodak did a 1-for-20 reverse split in 2021, holders saw roughly a 40% additional drawdown over the following 90 days. A $1,000 position there became about $600. While this isn't a reverse split, the issuance of so many warrants and fee shares at deep discounts in a private placement carries a similar risk of significant future dilution. The most favored nation clause is another big red flag. It means that any future financing the company undertakes could automatically improve the terms for these current debenture holders, likely at the expense of future investors or potentially triggering conversion that heavily dilutes current shareholders. Regarding the external context, we see recent news about a director, Ken Jisser, increasing his stake by buying stock and warrants around May 1st. This might seem positive, but it is happening right after this debt issuance and could be a way for insiders to try and signal confidence or consolidate control as the company navigates this tough period. So, what is my take on authID Incorporated after looking at this filing? The company is clearly facing financial pressure, resorting to a secured debt offering with significant equity kickers, the short. Term nature of the debt and the aggressive dilution from warrants and fee shares create substantial risk for existing shareholders. The most favored nation clause adds another layer of uncertainty about future capital raises. My biggest concern is the company's ability to manage its cash flow and debt obligations over the next 6 months without significantly diluting its existing shareholders or facing asset seizure. What I am actually looking for is clear evidence of a sustainable business model that can generate revenue and profit to avoid these types of desperate financing measures. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.